We're going to go through a case study now on crops and timber. There are a plethora of assets within the agricultural community that can be conducive for charitable giving. And you may have heard me say in the past, some of those charitably inclined people in this country are closely held business wealth holders and real estate holders. And almost without exception, that is the case. Well, what are farmers? Farmers are both. They've got the closely held business, the farm, and the farm is based on real estate. So we do a lot of gifts with farmers, and in particular around crops and timber. There are other sorts of mineral assets, oil and gas as an example. There are some more esoteric ones around ditch rights and water rights and other kinds of things that we've worked on in the past. But crops and timber tend to be the most prevalent that we see in the agricultural community. So similar to other examples, I want to go through a case study to identify some of the key planning considerations and aspects that might be helpful for you and your clients. So let's talk about crops and timber to start. So what is that? Those are things obviously that grow out of the land, and timber may not seem like a crop, but it is. It's really just a long time horizon crop typically. So much of the tax considerations are very much the same between the two. The timing, however, is a bit different. So in this case study, we're going to talk about soybeans. So we did a gift about 3 years ago, 20,000 bushels of soybeans. More common would be soybeans, wheat, and corn that we typically see. So we have a farmer. The farmer has had a successful crop and is working with his financial advisor, and he, let's say, is a charitably inclined person. And rather than giving cash is not good from a tax perspective and other perspectives, he's working with his advisor, and his advisor might say something like, well, have you considered other assets to be able to give? And let's think about perhaps the crop. So how does that work? It is quite simple, actually. So in this case, we've got 20,000 bushels of soybeans that are donated, basically assigned, a futures contract. Usually it's a 1 to 2 page document, giving that to, in this case, a public charity that's a university. A large number of gifts for Midwestern universities, for all the obvious reasons, come in the form of crop gifts. So this would be a very typical sort of scenario. So now the charity receives the actual contract to actually harvest. So at this point, the crops are in the field. The contract comes in, and then that contract can be sold through a commodities broker to, obviously, an end buyer. And then the farmer at that point would be responsible for harvesting the crop and delivering the crop at a date specified, terms of the contract itself. So what does this mean now from a tax perspective? In some ways it's not great. So let's start there, because a crop, being an active business, is ordinary income. And also keep in mind the rules around short-term gain and long-term gain, even if it were to be capital gains. Most crops are planted and grown within that 1 year period, so still would be short-term gain property. However, for many farmers, being able to eliminate that ordinary income can be advantageous. By giving the crops in the field, they don't have to recognize that ordinary income, and therefore they're able to give through that futures contract the sales proceeds to the charities of their choice rather than giving cash. So taking those crops, converting that into cash, spiking income for the ordinary income tax, and then giving the net over. In many cases, it's actually advantageous to give the crops first, prior to harvest, prior to sale. Now, with this in particular, too, because it's ordinary income, the income tax deduction is reduced under the ordinary income rules down to cost basis. And cost basis for crops are the cost of goods sold, or the cost of the crop itself, basically the basis inherent in the crop. So while the deduction is at cost basis, if there is strong gain in that crop, that gain is eliminated, at least for the farmer, and the charity does not have to pay any tax on that gain. So that's a quick example about how crops from a farmer can then be donated to fulfill charitable intent as part of a planning process, rather than using cash. On a timber basis, to talk about that very, very briefly, it's different. There's not much more complicated than timber. You've got a crop, but I want you to think about this. If the land with crops or timber were donated to the university, there would be a full fair market value deduction for that gift because the crops are part of the land. It's still all real property at that case. Timber would work the same way. But now let's think about timber, the value on the stump. When you cut that last fiber, it's kind of interesting to visualize, the last fiber of that tree, it immediately becomes tangible personal property. It's property that can be moved. So now all the tangible personal property rules apply for timber. So when we go to the opportunities in the next section, we'll talk about some other ways that timber can be used to fulfill charitable giving objectives. Okay, so on this slide we're going to talk about charitable planning considerations, again with crops and timber. And we just talked about the opportunities. So the opportunities are if crops are donated, it's at the cost of goods sold, their cost basis, and ordinary income is usually not recognized. So for any farmer with any kind of crop, that can work quite well as long as they're charitably motivated anyway. With timber deeds, as I just mentioned, it's different as it relates to the fair market value deductibility. So if it becomes tangible personal property, in that case, it would be the cost basis unless the charity can somehow find a way to put that timber to a related use, which would be quite difficult. But a way around that for some states is to actually transfer, again, the same futures contract, but to a charity. It's called a timber deed. So we're working on one of these right now in Alabama, very, very large potential gift, where the timber deed would be transferred, in this case, to a public charity that has a donor-advised fund. And then we would sell that deed to a commodities broker who would then have the right to cut that timber and then sell that timber. In that case, if the timber deed is long-term capital gain property, then in that case it can be deductible at full fair market value. This is a very complex area, but there are opportunities if you have clients who have crops, have timber, or you have donors obviously with crops or timber, that these are assets, in many cases with very high value, that can be used for these kinds of gifts. Finally, we're going to talk about the traps, and you see more traps here than opportunities. That's just how the bullet points laid out. So I've really talked about most of these. Only fair market value deduction if attached to the land itself, because that's still a real property gift. It's not bifurcating the crops from the land at that point. Crops are usually ordinary income assets, so deduction is generally the lesser of cost basis or fair market value and subject to the 50% AGI limit. That's again gifts to public charities, of course. Be very careful about the tangible personal property rules as it relates to timber, as well as the partial interest rules. This comes up from time to time. So to clarify, if I have land and it has timber, could I go to the university and say, university, I love what you're doing with the campaign, or this perhaps forestry management school or business school. I want to give you my real estate that has all of the timber, but I want to retain my timber rights or crop rights. Can't do that. So that would be a partial interest gift and therefore would not be allowed, at least for deduction purposes. So be very careful about making sure that if you're splitting any of those gifts and the asset between, in essence, the mineral rights and the actual underlying land or real property, that you want to do that in such a way to be able to maintain the full fair market value deduction on that gift. And my final point here, state rules vary enormously. So certain states are very open for these kinds of gifts, in particular timber, and deem those to be capital gain contracts. Other states do not. So definitely always work with an expert, but in particular in this case, working with a CPA or attorney in particular that specializes in these kinds of assets where there may be a fair market value deduction, to be very careful that it can be designed to make sure that that is maintained and the integrity of the deduction is very sound too.